Hello everyone, thank you very much for joining me. This is going to be my first video explaining my project StrategicWaves. My name's Stephen Tobin, as it says on the screen. I'm an independent analyst with the Seeking Alpha platform, and I invest my money privately on behalf of myself and my family. I'm going to try and explain exactly what this project's about and how I got to where I am. Hopefully you'll find it interesting, and hopefully you'll decide to follow what I'm doing and watch future videos, and hopefully we can make a little bit of money together. Now, in truth, this project started quite a long time ago. Way back, as you can see on this, I started publishing pieces of investment work. This was way back in 2015 when I was looking at Forex and how to invest in Forex using technical charts and technical indicators. This is one of the very last ones I published around 2015, and it follows about 4 years of work where I was looking at every type of technical chart, and I managed to prove to myself that none of them work. There is no combination of technical charts that leads to profits. I tested every single one on every Forex pair that was available. It took 4 years, but in the end I absolutely convinced myself no solution exists. At the end of that time, I went back to doing what I'd always done in investing, managing the company, the family money. I now call it the company money because it's StrategicWaves, but it's the family money. I got an MBA from the Manchester Business School, one of the most prestigious schools in the UK, and for a long time I'd been managing the family shareholdings, which I inherited from my father, on a very old school technique, looking at balance sheets, looking at profit and loss accounts, looking at ratios, to make really good solid investment decisions, low risk, medium return investment decisions, and that was going really quite well. However, I completely missed the whole Tesla thing. I thought Tesla were going to go bust because their balance sheet was shot to hell, really. They had no money. They should never have got where they did, but they did. They were hugely successful, and it caused me to start looking at other things. And one of the first areas I looked, you can see on the chart here, Ballard Power, was the fuel cell industry, the whole hydrogen industry. And way back in 2019, I started buying shares at around $2 each, and the price just shot up. In no time at all, they were at $20. I multiplied the money by 10. I thought I was going to be a millionaire. I thought I was going to make money like we've never seen before in our lives. Around 2021, I decided I'd start writing about this, no longer writing about Forex, but writing about this investment decision on this new technology. And the process was really quite simple. I would analyze a company, analyze its technology versus the rest of the industry, and choose the ones that I thought were going to be winners. And I was doing extraordinarily well at it. I started writing on the Seeking Alpha platform. Here's my page on Seeking Alpha, and you can see 2021, when things were going really well, I started writing there, and I've written 114 articles and picked up 3,500 followers, which is great. I hope they like my work. I hope they continue to follow me. And things were going really well. The great thing about Seeking Alpha was that it really made me look in greater detail. I made better choices because the editors won't allow these articles to go through unless you've got a really thorough analysis. They don't necessarily have to agree with what you say, but they check that you've gone into the correct detail to make your point. And it actually improved my performance. Got to say, it did, made a big difference, improved my performance a lot. However, not soon after that, the whole hydrogen thing collapsed. At the time, I thought this collapse was COVID related. COVID obviously changed the entire industry, all industries, and so I ended up buying here at $21 and buying here at $15, always thinking the thing was going to recover and go back up, but it never did. It just kept collapsing, and to be honest, I lost most of the money that I'd made on this big upward. I kind of just gave it all back on this big down point. This pattern, this up and this down, we're looking at here on Ballard Power, but it's common to this new technology stocks. If we look at Beam, completely different industry. These make solar devices. We can see the same pattern. flying up, flying down. Once again, I bought Beam around here, managed to give all the profit back again on the collapse, but and I got fooled into buying again. I feel bought here, and the whole thing just wasn't quite working. I'm pretty sure I've got the competitive side of it correct, but I did not have at this time the rest of a true understanding of what's going on. Now, there's a company called Gartner, and they work on this wave chart that I've got on the screen now, and it shows this technology trigger. This is when the thing starts to fly higher, and this is the area that I was trading. Think I had this right, the technology trigger, looking at the technology, what it can do, looking at the competition, looking at how this thing can change the world and how fantastic it's going to be. The problem is, as Gartner rightly point out, the market is not logical. People buy into these things too early, before the technology is proven, before the business is proven, and inevitably people are disappointed and the thing starts to collapse. This is what we've just been looking at in real charts. It gets to the trough of disillusionment. This is the kind of the low point. And then for some companies start to go up the slope of enlightenment. And really, rather than buying here when the technology first goes, we want to be buying here in the trough of disillusionment and trading up this chart which provides long-term growth and profitability. Now, when I went back and looked at my Seeking Alpha articles, one of the great things, of course, with Seeking Alpha is it keeps your history for good. Everybody can look at it. You can't avoid things you've said. You can't pretend you knew what you were talking about when you didn't. And looking at my performance, we can see it's on the screen here for 2024. I've made 7 strong buy calls. 6 of them have been winners for 85% success rate, which is really good. I think that's pretty exceptionally good. Really proud of it. And indeed, my long-term strong buy performance is really very good. The area that's not great is my buy, my just buy. Only 21% correct, and in 2024, a slight improvement, but not much. Only 2 out of 7 for 28%. I'm pretty good at deciding when to sell. I've got a bit of a nose for bullshit. Know when I'm listening to a load of crap. Got that 100% right. And the same with the sell recommendations. On the whole, I know when I'm looking at a pile of poo, and I can call it correctly. But I just need to get rid of this low call. And so I went back and looked at, as we do, what was the difference, what was missing, what was not missing, on the calls that made it or didn't make it. And you can see that in this column here. Just go through what's missing. And I managed to convince myself, without doubt, the difference was the DCF, the discounted cash flow analysis. Now, if we go back to my Seeking Alpha page and we look at one of the strong buys I've made, let's look at this Aris Water article. If we go through Aris Water, it talks about the marketplace, what they've done, what the competition is, where they are in the industry, what's happening. I look at their finances. You'll see these 2 charts coming up repeatedly. Really, how's revenue going? How are profits going? How's free cash flow going? Look at the balance sheet. Always important for every company. But then these mathematical models. Now, these models take hours to complete, days often, because I've got to look at every single line of the balance sheet, every line of the income statement, every line of the cash flow analysis, and analyse them to come up with a prediction. Now, when that prediction gives me a firm date of when the company will start to generate real profit, positive cash flows, then I can make a realistic assumption of have they got enough money to get there. I can also work out, using a discounted cash flow, a fair value for this business. What should the shares be valued at? And I found that when that fair value is 100% more than the share value today, and when we have a break-even date that I can be fairly certain of, showing they have enough cash to get there. When those things are fulfilled, so we've got enough cash to get to break-even, an identified break-even date, a discounted cash flow fair value greater than 100%, on top of the competitive analysis that I've already been doing, then in those cases the hit rate goes from that 29% I was just talking about. That's the difference from this 28% up to this 84%. And so in future, that's the change. That's what we're going to be buying. We're just going to be looking at companies that satisfy everything. Now, if we go back to the chart, there's one other area I need to talk about a little bit, because the second part of the waves I use, that's where this strategic waves name comes from, the strategy side, and these waves to help me plan the marketplace. The other wave I use is Elliott wave, and however, the problem with Elliott wave is, I mean, you might know about Elliott wave, designed in the 1930s by R.N. Elliott. It looks at patterns that have happened in the past and makes some kind of prediction about what's going to happen in the future to the chart you're looking at. The problem is they're very subjective. You know, you look at themselves, you can draw your own wave path on and make any kind of assumption. Because of that, I use an automated tool. It's kind of like, it's machine learning, isn't it really? It's looking at what's happened in the past, making some idea about what's going to happen in the future. And I have to pay for this, but if I just click on this little W button, the thing makes a wave chart for me. And there we can see a simple wave chart. For Beam, it doesn't make a great deal of difference, but it's the second thing, the final part of the wave chart I look at. I want to see a good wave chart. Helps me to decide when to invest. Now on the board now, I've got Joby. Big believer in Joby, strong buyer of Joby, and the wave chart gives me times to buy. 2023 here was when I really started looking at Joby, and we can see that the Elliott wave chart is making predictions of it going to wave 1, wave 2, but then it gives us a prediction of where this next wave is having. If I project this pattern forward, we can see, I have to pull it down a little bit to see it because it's so far up this chart. Where is it? There it is. Wave 3, that's the path that Elliott wave suggests this thing's going on. Now, of course, Elliott wave is just looking at what's happened in the past and making some assumptions about what's going to happen in the future. In many respects, it's the same as AI today, generative AI today, looking what's happened and making a prediction. And so it helps me to set my target. So I'm in Joby. I'm in it until $21. We're currently at $6. My actual share is at $5.39. I bought significantly at $5.39, and I'm going to hold on to those shares and see how that goes forward. So that's an introduction. That's what we're all about. That's what I'm trying to do. I'm trying to use my competitive strategy analysis gained from when I did my MBA. I'm looking at the Gartner wave cycle to help me plan this new technology route, and finally looking at Elliott waves to give me a good idea of what the path forward is going to be. I hope that was okay. I hope you enjoyed that first article. I should mention we're also going to have interviews with company executives. I'll be loading a couple of those up today, because that kind of inside information you get from these company executives, it helps me build my mathematical models, helps me understand where they're going, what they're hoping to achieve, and just makes the whole thing far more successful. Thanks again. Hope you enjoyed it. Please subscribe if you want to listen to some more of these. Next couple of videos will be interviews with CEOs from small companies that I'm investing in or proposing to invest in, and later in the week I will provide an overview of where my current portfolio is, what I'm looking at to do with that portfolio, new things to buy, things to close. Thanks for listening. Hope to see you all sometime again in the future.